reveal the top 3 trading strategies to grow a small trading account for beginners. Now, some of you might think that this is too good to be true, but I've actually done it myself with a live trading account, turning $100 into over $1,000, a clean 10x return in under 30 days. And in this video, I'm revealing the exact strategies I use to make that happen so that you can learn how to grow a small trading account yourself. By the way, I created a free guide that compiles all the strategies in this video into one document. Inside, you'll find step-by-step explanation of these strategies, which you can use as a cheat sheet for your next trade. This guide is available inside my Telegram community, which you can join for free by clicking the link in the description below. So let's dive in. Now, before we reveal the actual strategies, there's something I need to make clear. These strategies didn't work just because they were good setups. They worked because I also followed a very specific set of rules when trading them. And without these rules, I would have never 10x my account. So before we get into the actual strategies, I want to walk you through the 4 key rules I followed that made this growth possible. And if you skip this part, the strategies I'm about to teach won't help you. So pay close attention. Now, when I was growing this small account, I couldn't afford to take average trades. Each trade I took needs to have a high profit potential. This brings us to the first rule, which is every trade you take must have at least a 1 to 3 risk to reward. What that means is, if you're analyzing a trade, the profit potential must be at least 3 times the risk. So for example, if I'm risking $20 on a trade, then the profit potential should be at least $60. Now, here's an example of a trade I'm not willing to take. Notice how this setup only has a 1-to-1 risk to reward. What that means is, if I'm risking $20 on this trade, my potential profit would only be $20, which is not enough. And that's why every strategy I'll teach later in this video will have at least a 1 to 3 risk to reward. So, having a high reward setup is important, but that alone won't grow your account fast. This brings us to the second rule, which is using a large position size. If you want to grow a small account quickly, you have to be aggressive and take more risks. That's exactly why this video is titled How to Grow a Small Trading Account, because this method only works for small accounts. Once your account gets bigger, it's not wise to take this much risk. So here's what I did with my $100 account. For every trade, I risk 20% of my balance. That means that if a trade hits a stop loss, I would lose 20%, which in this example is equal to $20. However, because I also followed rule number 1, which is only taking trades with at least a 1 to 3 risk to reward, that meant I could make 60% back, or $60, from just one winning trade. So one winning trade is enough to cover 3 of my losses. Now, moving on to the third rule, which is the most important one of all, and that is compounding my winners. This is what made my account grow so much faster than expected. Here's what it means. Let's say I started my account with $100, then I made a $60 profit from a trade. That brings my balance up to $160. Now, instead of locking in profits and playing it safe, I doubled down and continued risking the same percentage on the next trade. For example, let's say I found another potential trade setup. This means I'll now risk 20% of my $160 balance, which is $32. So if the trade hits the stop loss, I would lose $32. But if the trade wins, I would now gain $96 because of the 1 to 3 risk to reward. So by continuously compounding the wins onto my next trades, I was able to grow the account so much faster. Now for the fourth and final rule is I only take trades on medium time frames, and that is between the 15-minute to the 4-hour chart. The reason I avoid higher time frames like the daily chart is because each candle takes too long to form. If I want to compound my account fast, I must use lower time frames. On the flip side, I also avoid time frames the 15-minute to the 4. Now for the fourth and final rule is I only take trades on medium time frames, and that is between the 15-minute to the 4-hour chart. The reason I avoid higher time frames like the daily chart is because each candle takes too long to form. If I want to compound my account fast, I must use lower time frames. On the flip side, I also avoid time frames that are too low like the 1-minute chart because it's extremely volatile, and the strategies I'm about to teach don't work well on very low time frames. So the sweet spot is between the 15-minute to the 4-hour time frame. So now that you know the key rules to follow when growing a small account, let's get into the top 3 trading strategies you can use. Starting with the first one. This strategy is all about taking advantage of trends, but instead of chasing the trend, the key here is to enter during a pullback of that trend. This way, when the trend continues, you'll end up with way more profits because you entered with a better risk to reward. So here's how the strategy works. Step 1 is to first identify the direction of the current trend. Is it an uptrend or a downtrend? The easiest way to do this is by using an indicator like the 50-period exponential moving average, or the 50 EMA for short. To identify the trend using this indicator, we simply look at the direction of the indicator and the position of the price. So if the EMA is sloping upwards, like this, and price is above it, then it's a clear uptrend, which means for this setup, we'll wait for a pullback downwards to enter a long position. Now, if the EMA is sloping downwards and then price is below it, then it's a clear downtrend, which means we'll wait for a pullback upwards to enter a short position. Now, the obvious question is, how do we know the exact spot where price will make a pullback? This brings us to the second step. Look for something called a fair value gap. For those who don't know, a fair value gap is a setup where the high of the first candle and the low of the third candle don't overlap with the middle candle's body. This creates a visible gap called a fair value gap. So remember, if there's no gap, then it's not a fair value gap. Now, why does this matter? It's because when a fair value gap forms on a chart, price usually has a high chance of pulling back into it, almost like a magnet. Most of the time, it'll retest the gap and bounce off it, continuing the direction of the original trend. And it's during this pullback is where we'll enter our position. One thing to remember is, for a fair value gap to be considered valid, it needs to be large. The larger the gap, the higher the chance that the setup actually plays out. If the gap is too small, there's a high chance the setup could fail, so it's best to avoid trading it. Now let's implement this in a real example. Again, the first step is to identify the current trend. In this case, we can see that initially, price was in a downtrend, as shown by it staying below the 50 EMA. Then, price price crosses above it, signaling a shift into an uptrend, which means we're now looking for a pullback to buy into this current uptrend. The next step is to look for a fair value gap, and right here, we spot a large green candle, where the high of the previous candle doesn't overlap the low of the next candle, creating a fair value gap. The size of the gap is also quite large, which makes it valid for entry. The next step is to be patient and wait for the price to pull back into the gap, but we also want to make sure that the uptrend structure remains intact and that the pullback isn't too deep. In this example, price eventually pulls back into the gap. Now, ideally, we also want to see some confluences here, which simply means that there must be other factors confirming the setup besides the fair value gap alone. In this case, we can see that price is also sitting on the 50 EMA, acting as a support level. This gives us extra confirmation that it will likely bounce from this area. From here, we can enter a long trade, with our stop loss placed just below the fair value gap and our take profit set at 3 times the risk. As you can see, price bounces perfectly and hits our take profit target. Let's look at another example. Here, we can see that the 50 EMA is sloping downwards, and the price stays below it, making this a clear downtrend. This means we're now looking for a pullback upwards to enter a short position. Next, we can spot a bearish fair value gap from this large red candle, where the previous candle's low doesn't overlap with the next candle's high. Once the fair value gap is identified, the next step is to wait for price to make a pullback and fill the gap, ideally with confluence. In this case, price retraces into the fair value gap while also touching the 50 EMA. From here, we can place a short position with our stop loss slightly above the fair value gap and our take profit set at 3 times the risk. And as you can see, price drops perfectly and hits our take profit target. Now moving on to the second strategy. For this one, we're taking advantage of trend reversals. For example, if price is in a downtrend, we'll try to spot the exact moment where the downtrend is about to end so that we can time our buy entry right before the trend reverses. Now, of course, timing reversals like this isn't easy. Luckily, there is a way to do it with high accuracy, and that's by using volume. For those of you who don't know, volume in trading simply measures the strength behind a price movement. For example, if price is in an uptrend and volume is high, it means that the uptrend has a strong momentum behind it. Same goes for a downtrend. If price is dropping and volume is high, it means that the downtrend has strong momentum behind it. But here's the key. If you start to see the volume decreasing, that tells us the strength of that trend is now getting weaker, which could be an early clue that a reversal might be coming. So by using this concept, we can start to predict when a trend is about to reverse just by watching the volume. So here's how the full strategy works. The first thing you need to do is apply the volume oscillator indicator. To do that, go to the indicator section on TradingView and type in volume oscillator. Click the default one and add it to your chart. Once it's applied, aim your mouse at around the 30% level of the indicator, then draw a horizontal line. If you're using TradingView, you can press Alt+H to easily draw this line. Once the indicator is ready, let's break down the exact entry conditions. Step 1. We're looking for a setup where the volume indicator crosses above the 30% line we marked earlier. This shows us that there's a spike in volume. Step 2 is identify the trend that led to that volume spike. For example, here, we see that when the volume spike happened, market was in a downtrend. So our objective is try to time the end of this downtrend so we can open a buy position and catch the reversal. This brings us to step 3. Wait for the volume to drop below the middle line. This confirms to us that the downtrend is losing strength and that a reversal is likely coming soon. Step 4. We want to wait for price to start forming a reversal while the volume crosses back above the middle line. The logic for this is simple. We want to confirm that the reversal is actually backed by rising volume, because if that potential uptrend isn't supported by increased volume, it means the move is weak and most likely won't last. Once the trend reversal is confirmed with high volume, that's when we enter a buy position. Next, place your stop loss just below your entry and make sure to give it enough room to breathe so you don't get stopped out too early. Then, set your take profit at 3 times your risk. Now just let the price run. And as you can see, price reverses and hits our profit. Next, place your stop loss just below your entry and make sure to give it enough room to breathe so you don't get stopped out too early. Then, set your take profit at 3 stop loss just below your entry and make sure to give it enough room to breathe so you don't get stopped out too early. Then, set your take profit at 3 times your risk. Now just let the price run. And as you can see, price reverses and hits our profit target. Let's look at another example. Again, the first thing we want to see is a volume spike crossing above the 30% level, like in this example. Next, identify the trend that led to that volume spike. In this case, it's an uptrend, which means we're waiting for this trend to end so we can time the short entry and profit off the reversal. After that, we wait for volume to drop below the middle line, like this. This gives us even more confirmation that the uptrend is likely losing strength. And looking at these candles alone, you can already tell that the trend isn't as strong as before. Next, we want to see price forming a reversal while the volume crosses back above the middle line. This confirms that the new downtrend is backed by strong volume. So once all the conditions are met, we place a short position. Next, we can place a stop loss slightly above our entry, and take profit is set at 3 times the risk. As you can see, price reverses and hits our take profit target. Overall, this strategy works great for growing small accounts, since entering before the start of a new trend tends to give you a take profit. Once all the conditions are met, we place a short confirms that the new downtrend is backed by strong volume. So once all the conditions are met, we place a short position. Next, we can place a stop loss slightly above our entry, and take profit is set at 3 times the risk. As you can see, price reverses and hits our take profit target. Overall, this strategy works great for growing small accounts, since entering before the start of a new trend tends to give you a much better risk to reward setup. Now moving on to the third strategy. For this strategy, we're going to use a concept called trend lines, a simple line that connects multiple swing points in price. The key idea behind the trend line is that if price breaks out of it, there's a high chance it'll move sharply in the direction of that breakout. So, if we can time our entry before the breakout happens, we can potentially enter a setup with a very strong risk-to-reward ratio. That's exactly why this is one of my favorite strategies. But of course, to make this work, we can't just draw a random trend line and wait for a breakout. If the line is drawn slightly wrong, you could end up entering at the wrong place. So here's how to trade the breakout strategy properly. The first step is to identify a trend line setup, and this is the most important part because a lot of traders get this wrong. To draw a valid trend line, you need to find at least 3 swing points in price. If it's anything less than 3, it's not valid. Once you found 3 swing points, connect them with a line. Now here's something important. Before drawing a trend line, make sure you also check the direction of the trend. If the market is trending down, you draw the trend line connecting the swing high points. If the market is trending up, you draw the trend line connecting the swing low points. Once you've drawn the trend line, the next step is to wait for a breakout confirmation. A common mistake I see traders make is when they see price slightly broke out of the trend line, they assume that it's a valid breakout already. But that's a big mistake because this will lead you prone to fake breakouts. For example, if we had drawn the trend line just slightly lower, it would have triggered multiple fake breakouts. That's why the correct way to do this is simple. We wait for a significant breakout. Something like this. Once a valid breakout is identified, we can move on to the last step, which is entering the trade. For our entry, I don't recommend entering immediately after the breakout because at this point, price had already moved too far, which will give us a bad risk to reward ratio. So a trick that I use is to enter during the pullback after the breakout because what usually happens is after price makes a sharp breakout, it will often make a slight pullback, retesting the trend line before continuing its direction. Once we get that pullback, we can enter a buy position. And because we waited for a pullback, this gives us a better risk to reward entry. I like to place a tight stop loss just below the trend line. And for the take profit target, we can aim for 3 times the stop loss. As you can see in this example, price continues moving up and eventually hits our take profit target, a clean and successful trade. So those are the top 3 strategies I use to 10x my account in less than 30 days.